Hello and welcome to the latest Insider interview. Our guest today is Glennie, manager of the abrdn UK Smaller Companies Growth Trust. Abby, thank you very much for coming into the studio.
No, thank you for having me.
The economic environment in the UK is changing. Interest rates are falling, inflation is back around 2%. So how will this new environment affect how smaller companies perform?
So I think there's probably two sides to that, which is how actually the companies themselves might thrive, but also the dynamics that drive equity markets often. So we believe that rates falling will be a positive for UK small cap as an asset class, particularly if you compare relative to large cap. And also we would believe that that should be a style benefit for us. So falling rates should favour growth companies more over value, and we are very much focused in growth company space. We absolutely saw both of those things work against us when rates were rising. So I think now we're on that pathway, and it feels like investors have confidence that we're on that pathway of rates coming off. And it's more about the pace of that decline as such that is the unknown. So we would think that's a positive. I think in terms of the companies, the UK small cap space, absolutely. So about 50% of revenue actually in the trust, but also just in the asset class is generated overseas. And about 50% is UK. I think what we're seeing is more health in economic growth coming through. And I think that's a real positive. But importantly, we also are picking stocks who we think have levers for growth. So, that's what we're trying to do is invest in companies who we think are more in charge of their own destiny in that aspect. So, that they have a good growth strategy, they have angles they can pull, they have new products or services or new geographies. And I think as we've seen that sort of economic strength start to come back, it's a real opportunity for some of our companies to thrive again.
Have you made any tweaks to the portfolio then, given this new economic backdrop?
So, we try and be stock pickers, bottom-up stock pickers, but you absolutely have to consider the macro. So we try and do that based on, how that's impacting companies, but you also have to be aware that in certain periods, macro can really dominate. And that is where our risk tools really come in terms of controlling those factor exposures. I would say we've had higher turnover over the recent year. And I think that's quite healthy at this point in the cycle. I think that just shows where, we're at a turning point in an economic cycle, and you would expect that different companies become quality growth and momentum through that. Now, some of them absolutely will thrive throughout, and I think that's where a lot of our longer term holdings, which are sort of resilient businesses, good revenue visibility, where they continue to thrive. But I think that actually, we've seen a lot of the Matrix, for instance, our stock screening tool, push out a lot of diverse new ideas for us, which we've acted on. But that also means that you have to exit some holdings. We're trying to find cash, I guess, from elsewhere. So I think the challenge with this cycle is that the length of recovery for some sectors and some areas has been longer than anticipated. And that's really where Amanda and I have moved on from some holdings that we had, where absolutely, look, if a company is going through a shorter term, tougher period, we can see that investment case improving, we feel positive about the outlook, we will hold on to that. But where that pathway of recovery gets pushed out and elongated, those tend to be the ones that Amanda and I have stepped away from. And I think one of the great things actually about the Matrix is that it doesn't know these companies. It's never met the management team. It doesn't have any emotional attachments to stocks. So it keeps you really neutral in that sell discipline.
Can you give some examples of the sectors and companies that actually are struggling in this new environment?
So I think, some of the areas that we've been a bit more cautious on recently, I guess, would be some of the tech companies which had really strong earnings growth periods in COVID, for instance, and in the years after that. It's not so much that they're struggling, but they're not growing at the rate they had, and therefore that hurts their earnings momentum, and that's a challenge for our process. We've seen, for instance, the recruitment space. I would say the recovery there has been slower than anticipated. We're also seeing in some of the sort of housing and construction related names, I'd say that's also a cycle which has, I think now there's macro which helps support the recovery of that. But I think particularly when you look at some areas, they can be later cycle in that. So for instance, one thing that we do hold is Mortgage Advice Bureau, which, I think it has a couple of benefits. It can be earlier cycle in that activity pickup. It also can grow as well because it'll have the confidence to add advisors. And also it benefits from remortgaging activity. And, we can see in terms of visibility, the remortgaging cycle that sort of has to happen in the UK domestic space.
We have a new government in power now in the UK. We've got a big budget coming up. So how does this impact the investment environment in the UK and particularly smaller companies?
Yeah, I think it's a really interesting time because, the budget is a few weeks away now. So comments can age quickly in this space. I think how we feel is, we were glad to see actually that, there was a really clear outcome on the election, because I think that has allowed that government to really just move on with things. Definitely all the metric we hear about driving economic growth is a real positive, and a real positive for UK small cap. And I think the other supportive thing we've seen lately is much more discussion and hopefully action about the awareness of what they need to do to drive a really healthy listed stock market in the UK. There's been a lot of research and papers and things about the shrinkage in UK small cap, how costly and challenging it is for companies to list here. And we've also seen, in terms of open-ended vehicles, we've seen, really tough flow environment for years, and UK pension funds are really not supporting UK listed markets at the moment. It feels like the government is now behind that and taking action on that. The areas that I worry about a little bit is, I think the real thing overhanging UK small cap at the moment is the risk around AIM. So there is a lot of discussion that perhaps they will make some business property relief changes in the upcoming budget, which impacts inheritance tax. Now, this is an area why we have, for instance, the IHT funds are AIM holders. So we've seen a real, what I would call a buyer's strike in AIM over the last month or so. I don't think it's been driven by outflows, but just a lack of inflows. So we really have seen AIM underperform versus FTSE. What I would hope from the budget is that we don't see a change. And actually, I think what we really need is some clarity, to remove that overhang risk. So I think everyone will be listening with great attention on the 30th of October as to what they say. I think the last thing is, there's a lot of areas that Labour talk about trying to drive. So for instance, I think housing is one that people hear about a lot. But we have to be aware that, there are not masses of surplus of funds out there for them to be able to drive certain areas. So I think that's the nervousness at the moment, is just, where are they going to find some of the capital to really do what they say they want to do.
This AIM story is really interesting. So is that somewhere you invest? And are you seeing opportunities given the poor sentiment to the market currently?
Yeah, so we do invest in AIM. So at the moment, the portfolio is about 26% in AIM companies, and our benchmark though also includes AIM. So the benchmark that we look at is the Deutsche Bank newest smaller companies plus AIM. And so that is about 27% AIM. So actually, we're neutral in terms of weightings versus the benchmark. I think that the risk versus opportunity, the challenge is, I think it's a bit of a binary event. So I think although there are opportunities definitely in terms of the pressure we've seen on some, really great quality AIM companies that have, reported, have been growing earnings really well, have and beaten their expectations, but their share prices have lagged, and I think partly because they are AIM listed. But I think the challenge is that these things are never priced in. So if we get a bad news event on the day, I think we will see a harsh reaction in AIM. I don't actually think we'll have, big sellers on day one. These AIM IHT funds will take time to actually manage what they happen, and perhaps it will only impact as well new money into the IHT funds. But we definitely, we think our companies will be fine. I mean, we are weighted in the larger cap companies within AIM. So what we would expect most of them to do if AIM becomes a not attractive place to invest anymore, we would expect them to move to main listings. And hopefully there are some sort of easier pathways that can be created for that to happen. But yeah, I think there is a risk on the day around AIM.
Investing in UK smaller companies is seen as a high risk, high reward part of the investment world. So what do you do if things are going really well or really badly in some of your positions?
Okay, so I think that people look at smaller companies as the riskiest asset class, often within equities. Now, I think there is absolutely volatility within the space, and that's why we always encourage clients and investors to take a longer term time horizon. So we tend to talk about 5 years. So for instance, if we look at the holding period for the trust and we look at the returns volatility, there absolutely has been a good entry point and a bad entry point. But actually, if you've taken a 5-year holding view, you've generally always generated a positive return. And we've always generated as well a better return than the benchmark over that. Now, if you'd got your timing the best it could have been, I think you've generated up to 25% return per annum. So yeah, I think holding period is a really important point in that volatility. I think the other thing is it depends what the investment process is. So our quality growth momentum investment process, the quality aspect of that, I think is really important in terms of volatility protection. So if we look over the long term, actually, when we look at the sort of the upside and downside capture, so how is the fund held up in difficult market environments, for instance, actually, that is a period that sometimes we've generated our best relative performance. So we do manage to, with that quality bias, through longer term periods, we've often protected assets in the downturn. What do we do with stocks? So if a stock's doing really, really well, we're not scared to add more to that. As long as the investment case still stacks up, as long as the matrix still likes the stock, as long as when we look at valuation, it still looks palatable, given, everything else that's going on with the business. So, we will run our winners, but we will also add to those. Similarly, though, we are not scared to exit a company when it's done badly. Not all investment cases, sadly, play out the way you expect them to. So I think, once again, this is where the matrix is a really useful tool for us. But if we don't see that investment case reverting, in a suitable time period, then we will move on from that and redeploy capital.
The discount on the trust is about 12%. So how does the board manage that? And is this an opportunity for investors?
Yeah, so the discount has been frustrating over recent periods. And, we're not alone in that. If you look at the other trusts in the UK smaller company space, but also the broader investment trust space, discounts have generally been a lot wider. And I think what you need to narrow those, I think, positive markets and positive performance are obviously a big benefit. But realistically, you need buyers. And I think that's the thing we see. If you look at flows in the open-ended space, I think they're a good read across. Flows have been tough into the asset class. Those are now starting to improve, though. So I would hope that we see a similar thing in the investment trust space. And, if we see, basically, you need more buyers than sellers in terms of trying to narrow those discounts. The board are very aware of the discount challenge we've had. We've had an ongoing buyback over recent periods, and we have bought back a lot of shares. But it has still been challenging to really narrow it much.
And finally, the question we ask all of our guests, do you personally invest in the trust?
Yes, so I own the investment trust, but also more broadly, a large part of my savings is in the products run within our team. So actually across the UK, Europe and global smaller company space. So heavily in small cap, but reasonably geographically diversified as well.
Abby, thanks very much for coming in.
No, thank you for having me.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.